Hi, everyone. It looks like we're getting everyone signed in. Welcome. Thanks for being with us today. My name is Lindsay Cates. I'm with the Trust Company of Tennessee, and we'll just give everybody just a few more minutes so they can all get signed in. Sometimes GoToMeeting has a busy place, so let everybody get signed in. Just watching our attendee numbers. So, climbing, it's climbing. It's like watching a race. It's exciting. We'll just give it one more minute and then we'll get started. While we're waiting, I'll just let everyone know if you have any technical issues or anything, go ahead and just put those in your chat or in the questions box on your control panel, and we'll try to answer those while Adam and Chad are presenting today. So, okay, looks like we should go ahead and get started. So, again, welcome. Thanks for being with us today. My name is Lindsay Cates. Like I said, I'm the marketing director for the Trust Company of Tennessee, and we're so glad that you could be here with us for our first Retirement Plan Academy. We're just getting started, and I'll give you a little bit of insight on why we thought this was a good idea. We have quite a few people with us today, so we're glad you thought it was a good idea. We know we probably have a lot of people who are current clients or know us professionally, but just in case you don't, we thought we'd give a little bit of insight into the Trust Company of Tennessee and also your speakers today. So our main goal for our clients is for them to live with financial confidence, and that means a few different things, whether it's making the best decisions for your family, your business, or in today's case, your employees' retirement plans. So with that said, why did we think Retirement Plan Academy was a good idea? Well, we have done a fiduciary training before, and it was really popular. We had a lot of attendees, and then we had a lot of people ask us to do it again. And so we thought, okay, great, we'll do that. I'll also mention that was a 2.5-hour session, so that was a lot. So we thought we'd try to break it down into more bite-sized sessions and hopefully not ask people for so much of a time commitment. In addition to that, this industry changes pretty quickly, as you know, so it's our hope that we can keep our clients well informed and help you make the best decisions for your employees' retirement plans. So that's why we have started this. We'd love your feedback. We're going to send you a survey at the end, so please let us know if we were right, if this is a good idea and you'd like this format to continue. You may have seen whenever you signed up for this that there are 6 planned sessions, and at the end of those, we have 6 more that are planned. So hopefully they'll be useful and good use of your time. So we hope you'll let us know. All right, so today Adam and Chad are going to cover the complex world of fees. I'm glad that they are the ones doing it because, my goodness, there are so many different ways to look at it. With that said, I guess I should tell you why Chad and Adam have any room to talk about this. For starters, Adam Davies is a chartered financial analyst. They both have alphabet soup after their names, so we try to keep our credentials current over here at the Trust Company. He is the vice president of retirement plan services and the smartest person we can find. If anyone ever has a question about retirement plans, Adam is always our go-to. Followed by Chad Scholart. His current title is Chief Development Officer, but he spent the majority of his time with the Trust Company being in charge of retirement plan services. So we promise he knows what he's talking about as well. Hopefully many of you have already experienced that and are willing to listen to him today. So with that said, one more item about housekeeping. We're going to take questions at the end of their presentations. So feel free to submit those along the way and we'll answer them all at the end. There's a questions bar on your control panel. I keep looking to it if that's what you're wondering where I'm looking. And you can submit them there and then we'll make sure to tackle all of those at the end. All right, with that said, I will turn it over to you, gentlemen.
Great, thanks, Lindsay. And today we're going to cover plan fees. And I know that this can be a very complicated topic, so our mission with today's presentation is to help simplify that for you. So here at the Trust Company, we work with approximately 200 different retirement plans, 31,000 different participants. And so we're going to give you some of the strategies that we utilize with them. We're going to go through some other structures that we see common in the industry, and then give you some best practices to help make sure that you're maintaining competitive fees for your plan. So why don't we jump right in and look at why should you consider plan fees? One of the major pieces of legislation that governs retirement plans is the Employee Retirement Income Security Act. This is commonly known as ERISA, and ERISA basically states that by offering a retirement plan, you are being stewards of other people's money. And so with that responsibility, you should have a high standard of care and diligence. So you can do this by selecting investments through a prudent process, ensuring the plan fees are reasonable for the services provided. Reasonable is going to be the key word here, and we're going to talk about that a little bit later. Disclosing plan fees to participants at least annually, and then monitoring those fees periodically to ensure that they remain competitive. So when we talk about trying to minimize fees, what we see is that even small fee reductions can lead to really large results over long periods of time. So in this example here, we have an employee that has a salary of $40,000, and we can see that by reducing their plan fees by 0.5% over their working career can generate an extra $100,000 by the time they reach age 65, or an extra 5 years of spending in retirement. If we're able to reduce fees by a full percent, that would generate an extra $227,000 by the time they reach age 65, which would translate to an extra 13 years of spending in retirement. So you can see how even reducing fees by a small amount can lead to really large results over long periods of time. Here on this page, we've recently seen a large uptick in participant lawsuits against plan sponsors. And so these are just the lawsuits that have been filed in June thus far. But don't let this intimidate you. This won't be an issue if you're following some of the best practices that we're going to present later on today. But these are just examples of plan sponsors who hadn't benchmarked and maintained reasonable fees, in some cases even had excessive fees as part of their plan. So next, let's go into types of fees. And I believe, Lindsay, we might have a poll question. Is that correct?
We do.
Okay, can everyone see that poll question? How long has it been since you last benchmarked your plan fees? So we have 1 year, 3 years, 5 years or more, or never, or you can't remember the last time. If everyone could please select one, and we'll give everyone a couple minutes to consider it. Maybe just a few more seconds.
Adam, we get a little bit of feedback on your audio. It might be, yep, there you go, perfect.
Thanks, Lindsay.
You're welcome.
All right, so we have our results here. Looks like most have benchmarked their plan fees within the past year, so that's great. That's definitely something that would recommend, and something Chad's going to cover a little bit later. And for those that have done it 3 or 5 years or never, don't worry. We're not here to judge, and we're going to give you some best practices to talk about best ways to do that in the future. So with that, why don't we go into different types of fees and let you know some things that we commonly see. So generally, plan retirement fees fall into one of two broad categories. The first are administrative fees, and these are fees that would be paid to service providers for operating and maintaining the plan. Also, we have mutual fund fees, and so these would be charged by the asset managers, the fund families, for actually investing participant assets. First, let's look at administrative fees. And so we typically see two different service models, one of which probably applies to your plan. First, let's look at multiple service providers. So with your plan today, you may work with several different service providers. You might have an investment advisor. This would be someone that helps select the funds for your plan, monitors them, does the due diligence to make sure that they remain competitive. You might work with a second company that does your record keeping. This would be keeping track of participant balances, the cash flow of the plan, any distributions. You might work with a third company for your administration. This is sometimes referred to as a third-party administrator, and they do all the required government testing and compliance work with the plan. So that's one service model. Alternatively, you might work with a bundled service provider in which you might have one company providing all three of these services. That one company might do your investment advisory work, your record keeping, as well as your administration. So looking at mutual funds in your plan, you probably have several different investment options. You might have stock funds, bond funds, target date funds. Each one of these funds is investing participant assets according to a particular strategy, and as a result has a different expense based on the strategy they're trying to accomplish. And so that fee is referred to as a net expense ratio, and it's something that will be automatically deducted from participant accounts throughout the year. So with that, I'm going to turn it over to Chad, and he's going to talk a little bit about how we commonly see fees being paid to these service providers and mutual funds.
All right, let's move along to the next slide here. So we're going to look at a couple different fee models, and what you might hear these referred to in different ways, but what we've got under scenario number one is individually listed fees. This is where fees are transparently listed or transacted. You can see on statements, or you can see them in some kind of charge, and these are going to be differentiated based on different types of services. So they could be administrative fees paid directly to providers. It could be advisory fees paid directly to advisors. There's also, typically in this model, you use low-cost mutual funds. And so in this scenario, typically, it's a little clearer, a little easier to understand, and things are kind of broken out by function. So you might see something like, fees in this scenario like $35 per participant, or for record keeping, it might be 25 basis points or 20.25% of assets, and for the advisory or the trustee fee may be 0.3% of assets or something like that. In scenario two, using revenue sharing, you might hear terms in this scenario like commissions, 12B1 fees, sub-TA fees, and in this scenario, things are, in our opinion, less transparent, and you can, in today's environment with the fee disclosures, you can get to the total amounts being charged, but you don't necessarily know who's getting paid what. That typically takes a little bit more digging. We'll talk about that here in a second. So definitely the industry is moving towards scenario number one, where all the charges are listed individually. You see the charges, they're transparent. We also noticed in the industry that the smaller your plan, typically you're going to find that that's under scenario two. So the larger the plan, typically in our industry, you're going to find that things are transparent and broken out by function and things like that. The smaller the plan, typically we see more revenue sharing, commissions, and things like that. So, but definitely the industry is moving as a whole towards transparency. So looking at share class on the next page, this is a hot topic because a lot of the a lot of the lawsuits that have occurred lately are really based on share class issues. So certainly aren't trying to pick on Principal here at all, but it just is a great example of how mutual funds have multiple share classes. And why do they have multiple share classes? It's the same fund, it's the same underlying investment. The only thing that's different is the fees. And so what you can see here is that in this particular target date fund, the management fee is the same for all the share classes, 0.65%. And then as you move across the table, what you can see is that there's added in additional 12B1 fees or other expenses. And those 12B1 fees or other expenses are getting paid to providers of some sort. It could be the record keeper, it could be the advisor, it could be the third-party administrator. The important thing to know is how all of that is being shaken out. So if you go back to think about the prior page under scenario 2 with less transparency, revenue sharing, this is an example of the types of funds that would be used in the revenue sharing model. So the institutional share class would be one that's used under the individually listed transparent model if you can get into the institutional share class. But then the other ones are going to have commissions paid out to providers typically. So the point here is that none of this is right or wrong. It's not good or bad. It's just you as a plan sponsor should know how this works for your plan. And I can tell you, if you're a trust company client, we use all institutional share classes as low as we can get, and that we also are completely transparent about all our fees. So we don't use any funds with revenue sharing or any kickbacks or anything like that. So it's very clear and plain and simple. Now, when we talk to other plans and we look at their plan, we're comparing to our situation, and typically, we're having to dig through to see who is getting paid what and things like that. In fact, Adam and I just were looking at one today and trying to decipher how the fees were getting distributed out to the different providers, and getting a good understanding of whether their fees were high or low or in the middle or reasonable or so forth. So moving along, a question we often get is, well, shouldn't plans just use all index funds, and isn't that the easy way to go? You just use all index funds and then you don't have to worry about fees. And so it's a fair question, but the answer for us is the index funds are great in some places, but they're not great everywhere. So we do believe that active managers can add value and add return. And so Adam, I'm going to get you to comment here too, because you're the CFA in the room, and you're more qualified to talk about this than me.
Sure. So for any of you that might not be familiar with index funds, essentially an index fund doesn't try to beat the market, it just tries to replicate the market. And so you're not paying a portfolio manager, a team of analysts to try and beat the market, you're just trying to replicate the performance of the market. And because you're not employing those extra individuals, you can do so at very low fees. And so with some index funds, we see their fee as low as 0.04%. For the net expense ratio. Alternatively, you might have actively managed funds, and those are trying to beat the market. And so we've done a lot of work here at the trust company to figure out where it's worth paying those extra fees and where it's not. And so what we've found is that in areas like large cap US, this would be studying companies like Ford, General Motors, Coca-Cola, some of the biggest household names, there's really not a lot of extra value that portfolio managers can provide in a lot of these spaces. And so we don't think it makes sense to pay those fees because it's going to be hard to justify extra value. But in other areas like small cap US, international, and fixed income. We do think that doing that extra homework, employing those portfolio managers to do that research can increase returns beyond the amount of their net expense ratio. And so we're very thoughtful and methodical in where we choose to minimize fees in terms of using index funds, but then using actively managed funds where there's an opportunity for extra return.
Great, thanks, Adam. All right, so let's move along to another section talking about fee disclosures. So there's two types of fee disclosures. One is called 408B2, and this is the plan level fee disclosure. So this is really kind of big picture. This is the one that plan providers will give you, particularly if you're making a change or if you're doing any sort of fee benchmarking. This is the one that's used for the plan level. Now the participant level disclosure is called 404A5, and that one is distributed out. You're required to distribute that out to participants each year, actually within every 14 months, but most people just do it once a year. And it's going to tell you all the things about the plan in terms of the cost of the funds, the charges that are paid. If you take a distribution, how much does that cost? Any of the fees associated with the plan are going to be listed there. Now, these can be very complicated. And so Adam and I have looked at multiple different fee disclosures, and sometimes it's an exercise in forensic accounting trying to figure out what the actual costs are for a plan. And I think, as I said before, the industry is moving away from some of the less transparent or more difficult fee arrangements and moving towards more transparency and more simplicity, because it's just not helpful to not know what's getting charged and who's getting paid what. I think it's important that you are distributing these participant disclosures, and that you are reviewing your 408B2 disclosure and understanding it. And if you are not understanding it, if you don't understand it, it's really important to ask your plan providers to be really clear about how the fees are being charged. All right, so the last section here is about fee benchmarking. I think we did a poll earlier about fee benchmarking, but this is probably a good place for this poll question. How confusing do you find plan fees? And so let's give a couple seconds here. All right. All right, so most people feel that plan fees are very confusing. Well, to be honest with you, I would agree. Being in the industry, I think they are very confusing. We haven't helped ourselves generally in making them really easy and simple. I guess I'll make a comment here. I think that it's important to know that, we don't, nobody is in this industry and not charging fees. I think sometimes we hear that, their plan is free or there aren't any fees. Well, there are fees on every plan. It's just a matter of how they're being structured. So one of the things that's really important to us is doing fee benchmarking for our clients. We do this for all our clients. We do it whether your plan is $500,000 or 150 million or on up. We do this regularly, number one, because we're a fiduciary, but number two, we think it's really important for our plan sponsors to understand their fees and then know if they're in line with their plan size, relative to others in the country. So on the next page, we just have a sample of one of the fee benchmarking reports we use. And what you can see here, it's pretty complicated in a lot of ways, but the point here is that if we're looking at a plan with $3 million and 285 participants, how do we know if this plan is charging fees in the right neighborhood? So on the left side, the blue section, that means the plan's really low relative to their peers for that group. If it's in the green zone, that's where we really want to be. And then if it's in the orange zone, it's probably a little bit outside. Now, what we're aiming for, what you as a plan sponsor should be aiming for, is reasonable plan fees based on your plan size for the services that you're getting. The goal is not to get the lowest possible fee. The DOL, the courts, that's not what they have said at all. They have said reasonable fees are what you're aiming for. So in this scenario, being in the green zone is what you want to aim for. There can be times when things are outside of the norm. You know, maybe if you've got employees all over the country and you're traveling to see those employees, well, somebody's going to pick up the cost for traveling to see those employees. In this particular case, this plan is outside, you know, it's pretty high, fees of 1.43%. So it's outside of the normal range for plans this size. So, you know, if we were showing this to a prospect or somebody, we would be talking about ways they could potentially reduce their fees. And it looks like in this case, the record keeping is a little bit out of whack, a little bit high. So we would be talking about ways that they may be able to reduce that. All right, so finally, this is just a sample of a worksheet that we use for folks. It really is very simple. We look at the fund costs, we look at break out the record keeping, we break out the administration charges, and then we total all that up. So what we're really aiming for is try to get down to a very simple calculation using dollars and percentages. We feel like it's important to show dollars and percentages, and then again compare that to your peer group, the industry peer group. It doesn't make sense to compare a $3 million plan cost to a $150 million plan cost. Those are going to be totally different, but within your peer group, you should be somewhat in line. So, all right, Adam, anything I missed?
No, so it looks like we're right on our 30-minute mark. So definitely want to thank everyone for listening today. I hope we've simplified fees for your understanding of your plan. And we do have a few questions, so I'm going to go ahead and turn to those. First, we have a good question here. What is a typical fee for a retirement plan? And so this really goes back to what Chad was talking about earlier and why you want to do benchmarking based on your specific plan size, because it really does depend on how many participants you have, how many assets you have, because you wouldn't expect a plan with $500,000 in assets to have the same fees as a plan with $500 million in assets. So we really see it depends based upon how many participants you have, how many locations, and all of the work done by each of the service providers working on the plan. Chad, I think this might be a good question for you. This person said, I don't see plan fees. How am I being charged?
Yeah, so that gets back to when we talked about transparency versus revenue sharing. And so if you're not seeing any transactions, then what's happening is most likely is that the fees are being all taken care of through the mutual fund expenses. So in this case, the mutual fund expenses are going to be fairly high because they're using revenue sharing within those mutual fund expenses to cover the costs of the record keeper, the advisor, the third-party administrator, things like that. And so, you know, you would want to use the 408B2 or the 404A5 to understand who's getting paid what and what, are those fees reasonable? And then secondarily, if you can benchmark your plan against your peers and see, well, in total, you're in line or you're out of line, that's really what you would want to do. But I can guarantee you there are no free plans out there. At least I've not run across any, and I've been in this industry for almost 20 years.
Neither have I. And we have another great question here. How does fee leveling work? So fee leveling is something you see whenever you are working in a revenue sharing model. And so let's go to this fund just as an example. And we can see that if we were to use, let's just say this R3 share class, there are 25 basis points or 0.25% of 12B1 fees and 0.31% of other fees embedded in this plan that are going to the investment advisor, the record keeper, or the third-party administrator. Now, as you look across all the different funds in your plan, some may have 0.25, some may have 0.5, some may have 0.4. The amount that goes back to the service providers could be all over the place. And so essentially with fee leveling is you would pick the number needed to go to the service providers. Let's just say it's 0.4 in this case. So if the fund only gives 0.25%, then there would be an extra 0.15% charge on top of that. Or conversely, if let's just say there was 0.5% 12B1, then participants would get a credit back of the 0.1% difference to the 0.4% figure needed for paying the service providers. So you essentially only see this in a revenue sharing model, and we at the trust company think that's a little complicated. And so that's why in our plans, we've structured the individually listed fees so that you can see exactly what goes to each service provider, and you're not going through that exercise of looking at the revenue sharing of each fund and then doing credits or doing additional charges to pay those service providers.
And I think the idea is that, a participant isn't going to get hurt by picking one fund over the other. They're not going to pay a higher or lower fee depending on which investment that they pick. I think that's the goal of fee leveling.
Great, and we have another question. This might be good for you, Chad. My fees aren't the lowest. Am I doing the right fiduciary thing?
That's a great question. So I think I said this earlier. You're not required by the Department of Labor or the court system. The cases have not shown that you have to have the lowest possible fee. That is not a requirement. What you're required to do is, as a fiduciary, is make sure that the fees are reasonable. So lowest does not mean reasonable. So paying for the services that you're getting is important, and paying a fair fee for those services is important, and monitoring and benchmarking those. But I think we all know that if you pay for what you get. So if you're gonna pay for cheap, then you're probably not going to get great service to you as a plan sponsor or to the participants. So I think that cheap is not always best. I think that you want to find a service provider that's going to charge a fair fee and provide you good services for those fees.
Great, and the last question we have is, I don't understand how to calculate my plan fees. Do you charge for figuring out plan fees if we're not a client? No, we do not charge for that. That's something we're certainly willing to help with. And based on the poll question, it sounds like you're not alone. A lot of people do struggle with trying to calculate their plan fees. But essentially what we would do is we would look at your 408B2 disclosure and then provide that apples to apples comparison. that you see right here to show you how much of your plan fees are going towards investment management funds, advisory services, record keeping, and then administrative fees. So that's something we're happy to do for you. And if you'd like to reach out, please do so after this presentation. All right, well, we'd like to thank everyone for joining today. We hope that after this presentation, you have a better understanding on your plan fees and that we've simplified what can be a very complicated subject for you and your plan.
Thanks everyone for being with us today. We hope that you'll join us again next month on July 30th when we're covering retirement plan committee best practices and investment policy statements. You can register for those in the same place that you registered for this. You may already be registered, so we hope you are. We'll give you another opportunity by sending another email invitation. And as another housekeeping item, today's session has been recorded and you'll receive that via email as well. If you have any additional questions, feel free to reach out to any of us individually. Both Chad and Adam's contact information is here and will be included in the follow-up email. Also, we appreciate your feedback. So there's a survey following signing out of today's presentation, and we hope to talk with you soon. Thanks so much.